As we're now in the midst of earnings season, earnings is all about volatility. Volatility going up, coming into earnings, volatility coming out after earnings. Now, what creates this is basically, very similar to what we were talking about earlier, is basically when people are coming into earnings, they're going to buy insurance because they're going to protect against, the stock going down. So they buy a protected put option to protect against the stock coming down, and that creates volatility going higher and higher and higher. And as the earnings date approaches, it's the most uncertain event in the entire marketplace. And so as earnings is closer and closer, volatility will go up, thus rising the value of options. Well, right before earnings is released, or after earnings is released, for that same reason, everybody's holding the protected put options. They're now going to sell them back to the market or exercise their right to short stock, and volatility will come out. And as you can see here on JP Morgan, volatility since the last month and a half has steadily risen. It's up here in the highs the same way it was all the way back here. So you're seeing volatility very high, and these means the options are priced a little higher. Volatility before earnings was very high, and then afterwards, so on and so forth. So when I'm looking at JP Morgan here, I'm saying to myself, this might be an opportunity to sell options. And so here I'm going to look at the earnings report is coming up right now, and how I found JP Morgan. We'll pull up an internet real quick. How I found JP Morgan is I ran a simple scan. So I said, all right, market cap, I want to look at plus mid cap stocks and above. Average volume, I want to look at over 500,000 shares traded daily. And then I want earnings date, let's do tomorrow. And that just gave me a list of 12 stocks. And there's JP Morgan right there on those 12 stocks. You might look at Intel as well, INTC, but we're going to look at JP Morgan. So coming back to the Thinkorswim here, we know volatility is high. We know earnings are tomorrow. We are going to sell earnings we're going to sell options today to capture the big increase in volatility, and then after the earnings date, we are simply going to close them after we see volatility come out of the of JP Morgan. So here, as you can see, it is widely expected that JP Morgan is going to gap somewhere around $1.76. Now that is basically the at the money strike price. So if we go to $59 and we say the at the money strike price, it has a value of $1, and a dollar, that's $2 minus the little bit of time decay, and that's your market maker move. That's what we expect. Well, on something like the short strangle benefits if it does not gap outside the range that we expect it to. And so what I'm going to do here is I'm going to take that expected market maker move of 1.76, I'm going to times it by 2, and that's $3.50. And then I'm going to sell out of the money by twice the expected gap range here in November. And so I'm going to sell the 55, which is right around $3 out of the money. I'm going to sell the 55, and I'm going to sell the 62.5, which is right around $3.50 out of the money as well. So now we're going to sell short strangle, change the call side to the one that we're matching of 62.5. We're going to receive $1.25, $1.26 credit. We're going to confirm and send, and that is on $839 of buying power. That's on portfolio margin. And so now let's go to our nice little calculator. Let's take the $1.25 received, divide it into the margin amount of $839, and that is a 14.8% ROI. And the reason we're getting such a high ROI is twofold. Number one, this on portfolio margin, and number two, the volatility is really, really high, which means we can sell options for very high. So now what we're looking at here, let's go back to mock trader very quickly. Let's type in JP Morgan. Okay, now we sold this 55 option all the way down here, and we sold the 62.5 option all the way up there. As long as it stays within that range right there, we are golden. Now the market expects it to move into this right around 60.74, and right around 57.5. So that's what the market expects. We sell all the way outside of there, and as long as JP Morgan does not gap as much as what we sold, we should be profitable on the trade. And when you look at JP Morgan has a very specific gap range. If you look at kind of the chart here, last time it had announced earnings right here, it gapped about $2. Here it gapped about $2. Here it did not gap. So when I'm looking at the average gap range, 2 out of 3 times it gapped $2, which is underneath the 3.5 we sold, and then one it really didn't gap hardly at all. So I'm thinking this is a pretty good little trade, little 14.8% ROI, and you would definitely, I'm selling in November just to get the extra time value. We're definitely going to buy it back right after the earnings as volatility comes out of it, and that is how you approach trading earnings on JP Morgan. Check us out at the website www.tackletrading.com. Check out the podcast, Trading Justice Podcast, on iTunes as well as at the website. Leave us a nice little review if you enjoy it. Coach's Show coming up tomorrow, Tuesday, October 14th. Many topics, including protecting your portfolios and looking at how to approach the market as it's starting to turn around. Looking forward to that conversation. Join us for the Coach's Show tomorrow for you pro members out there, and get out there and let's learn how to trade earnings. Maybe if we have never done it before, let's virtual trade a few times. Outside of that, we'll see you next time.